Welcome to Dorchester Advisors. Today we want to talk about the bear market of 2022. We hope you'll get some useful insights. In case we haven't met before, my name is Dushyant. I'm the founder and managing director of Dorchester Advisors. Here we work with individuals and families and help them construct solid investment portfolios that give them enough cash flow to sustain their lifestyle during retirement. So what happened in quarter two? Well, all the five asset classes we followed, the five main ones, were down. Cash was down in real terms, commodities were down modestly, but stocks, bonds, and real estate were down in double digits. So if you look at the S&P 500, for example, it was in bear market. Now, a bear market means that a particular index, like the S&P 500, has declined 20% from its high, which in this case was at the end of 2021. So we are in a bear market. But to hear media talk about it, a bear market suggests our economy is in shambles, that the companies that comprise the S&P 500 are hapless, and indeed our retirement portfolios are doomed. Look, I exaggerate, but not by much. So what is our view? Yes, we are in a bear market, but the fundamentals of the companies that comprise the S&P 500 will suggest, and indeed common sense will suggest, that these companies are doing quite well. Sure, there are weak sectors and weak companies in them, but there are also strong sectors with strong companies in them. And if you look at the other asset classes, they are down, but they're not without value. And usually when there is value, prices find a way to recognize that value. Look, we think companies are working fine for the most part, and they're facing the challenges du jour, inflation, supply chain, worker shortages, work at home, all these things. They're facing them. They have veteran managements, established managements that will find solutions. We believe that most US companies, indeed most worldwide companies, will find a way to overcome the shocks that COVID and Russia have imposed on them. It's uncomfortable, of course, but is it insurmountable? No. Oh, and what about inflation? Well, I tend to side with the financial markets. Look, the ratio between bonds, long-term bonds, treasuries, and tips suggest that the markets believe that long-term inflation over a 5 or 10-year period will average around 3%. And we've lived in eras where inflation has been double digits. So this will not be an excruciatingly new situation, except in the very short term. And I tend to side with financial markets because they comprise of thousands of investors who are stating their view with cold, hard cash, as opposed to the anecdotal and narrative type of sound bites we hear on the media. So what are we doing about all this? Well, for our clients, we deployed our down market playbook. All the things that a good investor can do when the markets are down, as happens inevitably. So, for example, we rebalanced portfolios. Where there was cash, we bought additional investments for clients, and so on and so forth through our playbook. Our basic investment philosophy is invest sensibly, invest prudently, which means take appropriate risks for clients' goals, and be cost conscious. We think this formula, we think this philosophy of investing is robust, and we still think it's a very good philosophy for a long-term investor. Hey, thanks again for coming and listening to us. I encourage you to look through our website, and if any of our ideas resonate with you, do give me a call, without obligation. We love talking all things investing.